What if everything you have been told about saving money is the exact reason you are still broke? Inside the vault, we call this the scarcity trap, and today we are cracking it open completely. Nick Maggiulli, the data scientist behind of Dollars and Data and COO at Ritholtz Wealth Management, wrote a book that dismantles decades of personal finance dogma with cold, hard evidence. His book, Just Keep Buying, became an international bestseller because it refuses to repeat the tired advice you have ignored 1,000 times. A quieter question will surface as we go deeper. Why might the very habit you think is responsible discipline actually be quietly sabotaging your future? Both answers exist inside this book, and both will surface before this video ends, reshaping how you see every dollar that passes through your hands. If you are watching this because some part of you suspects you are doing money wrong, you are not alone. By the end, you will understand exactly where to focus your energy saving, investing, spending, or all three. Hit subscribe and like because the book vault exists to hand ambitious people the unfair advantage the financial industry is quietly hidden from you. The Save Invest Continuum. We begin with the foundational mistake nearly every young professional makes, the chapter called the Save Invest Continuum. At 23, Maggiulli obsessed over investment returns on a tiny portfolio, while his spending habits quietly drained far more than any strategy could recover. He believed he understood wealth. He understood almost nothing. Most people listening believe they are responsible because they read about stock picks, but the book introduces a brutal test. Compare your expected annual savings to your expected investment growth. Whichever number is larger tells you exactly where your attention belongs. For a small portfolio, obsessing over it is theater, not strategy. This is where human nature turns dangerous. We chase the exciting half charts, tickers, dopamine, while ignoring the boring half that actually builds wealth early on. The author admits that knowing this continuum would have shifted his entire trajectory toward growing his income and career instead of refining a tiny portfolio. The next idea exposes the single biggest lie the financial media has been selling you, and it is far more uncomfortable than you expect: the income acceleration principle. Now we arrive at one of the most controversial ideas, the income acceleration principle. The author compares the obesity debate to personal finance. Just as pure exercise is incomplete for weight loss, pure spending cuts are incomplete for wealth. Most people believe their daily coffee habit is bankrupting them, but the book reveals that the bottom 20% of U.S. households already spend more than their after-tax income on necessities alone. Cutting lattes was never the answer. Shaming small spending is simpler than confronting income inequality. What happened next changes the argument completely. The most consistent path to wealth is growing your income and funneling it into income-producing assets, not white-knuckling through restrictive budgets. He points to selling skills, teaching, or building products, levers that spending discipline alone can never pull. And late at night, a quiet voice creeps in. Maybe the problem was never your spending. That thought is freeing because it means the real lever has been in your career and income potential all along, waiting for you to finally pull it. The guilt-free spending framework. Before diving deeper, we reach the guilt-free spending framework. The book introduces two characters, James, who spends recklessly, and Dennis, who hoards in anxiety. Neither extreme produces a satisfying life. Real peace lies deliberately between them. The author's 2x rule states that any meaningful splurge must be matched by an equal investment. The threshold is personal and shifts as your wealth grows. This transforms spending from shame into a ritual that balances discipline with enjoyment. Most people believe frugality is the ultimate virtue, but unexamined frugality often masks a deep fear of never having enough. The author leans on Daniel Pink's framework: autonomy, mastery, purpose, arguing that money spent toward those pillars compounds emotionally, just like investments. There is no universal formula, only self-discovery paired with intentional structure. Yet even the most balanced spending framework cannot protect you from the one force that destroys more wealth than any market crash, and it is about to be named. But here is the truth that nobody warns you about. The wealth you build can be destroyed, not by a single crash, but by 1,000 tiny upgrades you won't even remember making. The lifestyle creep ceiling. That quiet, daily decision to upgrade your life just a little more each year is the lifestyle creep ceiling. The book opens with Cornelius Vanderbilt, the wealthiest man in America. His fortune was doubled by his son William before later generations dissolved it through extravagance. Money did not fail them, discipline did. Some lifestyle expansion is genuinely rewarding, but the danger is expansion without limits. The book proposes a simple ceiling: save roughly 50% of every raise and enjoy the other half guilt-free. Through a mathematical comparison, higher savers must actually protect a larger share of raises to preserve their retirement timeline, an outcome most people never guess. The families who destroy generational wealth rarely do it through one disastrous decision. They do it through 1,000 small upgrades that each feel justified in isolation. Half is for you, half is for the future version of you depending on today's choices. The next layer moves into a topic most people fear discussing honestly: debt itself. The debt calculation and the rent versus buy question. We now enter the debt calculation and the rent versus buy question. The author introduces bet hedging from nature, where organisms sacrifice short-term efficiency for long-term survival, and applies it to why some stable people deliberately carry certain debts. Debt is rarely simply good or bad. What most people never reach is that debt can serve you well, reducing risk through liquidity in emergencies, or generating returns exceeding borrowing costs, such as financing education or a strong business. Context determines whether debt helps or harms. Most people think all debt is dangerous. The real danger is debt without a clear purpose. The author encourages calculating lifetime return rather than reacting emotionally to a loan balance. Then the conversation pivots to the most contested decision: renting versus buying. Maggiulli shares his grandparents' modest home, acknowledging the emotional return no spreadsheet can capture. He lays out often overlooked costs, closing costs, and agent commissions that can range from 5 to over 30% of transaction value. While renters face rising rents and instability, buying may not always be financially optimal, even when it is emotionally right. He insists the question is when, not if. Stay at least a decade, maintain stability, and arrive with a meaningful down payment and manageable debt-to-income ratio. And what comes next is where everything you've heard so far finally connects into something you can actually use: the time horizon method. We now arrive at the time horizon method. The book makes a definitive claim: cash is the safest vehicle for short-term goals because certainty outweighs inflation over a few years. For 2 to 3 year goals, bonds. For decades, stocks. This same thinking eventually resolves when you can retire. William Benjamin's 4% rule suggests withdrawing 4% annually from a balanced portfolio for at least 30 years, meaning you need roughly 25 times your expected annual spending. But retirement is equally a psychological and social transition. Spending naturally declines, and purpose often ties more to community and identity than to an account balance. Money solves logistical problems beautifully, but almost none of the emotional ones waiting beyond the final paycheck. What comes next is where we shift from saving to investing entirely, the human capital conversion. Now we shift completely into investing with the human capital conversion. The author gives 3 fundamental reasons to invest: securing resources for your future self, protecting against inflation, and converting your human capital, your skills and time, into financial capital before that human capital naturally diminishes. Deep down, you already sense your earning power has a shelf life through age, industry shifts, or physical limitation. Investing is the mechanism that transfers value from your temporary human capital into something durable and self-sustaining. Every year you delay this conversion is a year you can never recapture. Once that window closes, only the financial capital you already converted remains working for you. That is why investing is not a luxury, but a structural necessity. However, most people immediately make the wrong decisions about what to invest in, chasing individual winners. The next chapter confronts that danger directly, and what you are about to discover may be the most important reversal in the entire video: the index discipline. This next idea is the reason the book has stayed relevant: the index discipline. The author tells of his friend Darren, who bought GameStop stock during the 2021 surge, experiencing euphoric gains followed by devastating losses in a single afternoon. He survived only because he risked nothing beyond what he could afford to lose entirely. The financial argument against stock picking is staggering. Most professionally managed funds fail to beat their benchmarks over 5 years, and only a small fraction of all stocks have driven the majority of total market gains since the 1920s. Even professionals with research teams and decades of experience consistently struggle against this brutal math. The terrifying part is that stock picking offers no immediate feedback loop. You cannot know for months whether your success was skill or luck, and that uncertainty corrodes confidence. Owning a diversified basket through index funds removes this existential trap, freeing your mental energy for things that matter far more than monitoring a portfolio. The simplicity of indexing is not a compromise. It is a strategic advantage hiding in plain sight. But that discipline becomes even more powerful once you understand exactly when to deploy your money. The buy now imperative. We now enter what the author considers one of the most liberating chapters, the buy now imperative. Drawing from horse racing analyst Jeff Sater's discovery that heart size, not lineage, predicted equine performance, the author argues that investing has its own overlooked variable, the historical tendency for markets to rise most of the time despite every crisis. Most people believe waiting for a better entry price is responsible patience, but the data tells a different story. Investing money immediately, rather than gradually averaging in, has historically outperformed across nearly every asset class. Stocks, bonds, even gold. Even during periods of historically elevated valuations, waiting for prices to drop still underperforms simply investing right away. This finding demolishes the justification that today's prices are too high. The same logic extends to the trap of waiting for crashes. In the provocatively titled chapter, Even God Couldn't Beat Dollar Cost Averaging, analysis from 1920 to 1980 reveals that waiting to buy dips underperformed steady investing in over 70% of all examined periods, even with flawless hindsight. The scarcity of truly significant dips means the waiting strategy almost never pays off. The author's conclusion lands like a quiet thunderclap. Your specific strategy matters less than what the market simply decides to do. But what happens when you face the randomness of markets and the role of sheer luck? The next chapter strips away the illusion of total control, the luck reckoning and volatility, acceptance. We now turn to the luck reckoning and volatility acceptance. The author opens with Stephen King publishing under the pen name Richard Bachman, watching those books perform dramatically differently despite identical writing, a clear demonstration that timing and circumstance shape outcomes as powerfully as raw talent. The year you were born meaningfully shapes the investment returns available to you across your lifetime, and the sequence of returns matters tremendously. A downturn early near retirement can devastate outcomes far more than the same downturn arriving later. That thought feels almost insulting. Years of disciplined saving undermined by forces outside your control. But once you accept that, something empowering emerges. You always retain control over how much you save, which assets you choose, and how consistently you show up. Acknowledging luck is not an excuse for inaction. It is the foundation for humility paired with discipline. Consistency is your defense against randomness. And the discomfort of volatility? Since 1950, the S&P 500 has experienced an average maximum decline of nearly 14% within almost every single year. Investors who panic during these completely normal fluctuations consistently underperform those who simply remain invested. As Charlie Munger bluntly observed, anyone unwilling to endure occasional declines near 50% should not expect anything beyond mediocre long-term results. Volatility is the price of admission for long-term gains. Refusing to pay it guarantees you never collect the reward. That acceptance becomes most valuable precisely when markets feel most terrifying, which brings us directly into the most psychologically demanding chapter, the crisis conviction standard. We now arrive at the final major chapter, the crisis conviction standard. During the March 2020 collapse amid global panic, the author recalls watching a flower vendor continuing to work on the street outside. A small, almost invisible reminder that life and opportunity move forward even during historic uncertainty. The terrifying instinct is to hoard cash precisely when markets offer their most rewarding entry points. Baron Rothschild's famous warning, "The ideal time to buy is when there is blood in the streets," is supported by historical data showing that markets down 30% or more have frequently produced annualized returns exceeding 10% during subsequent recoveries. What happens next changes how you will think about every future downturn. The author acknowledges that some markets, like Japan after 1989, take far longer to recover, yet the overwhelming probability still favors long-term investors who continue buying through uncertainty rather than those who freeze entirely. Fear holds a far stronger grip on human behavior than even the most overwhelming weight of historical evidence. That feels like the natural conclusion, that courage during chaos defines long-term success. But there is something even more important waiting beneath the surface. The true lesson is not simply buying during crisis. It is having already built the financial structure, the saving habits, the income growth, and the psychological readiness long before that crisis ever arrives. Crisis conviction is not improvised. It is earned in advance to every single principle this masterclass has revealed. Inside the vault, we believe this final insight is what separates people who merely survive financial chaos from those who emerge from it transformed. Everything you have absorbed across this masterclass was never about memorizing rules. It was about rewiring how you fundamentally relate to risk, time, and money itself. And what comes next is where all of this finally settles into 5 lessons you can carry home tonight. Key lessons and insights. The Continuum Clarity Lesson. The first lesson is the Continuum Clarity Lesson. Before optimizing anything, honestly determine whether you currently belong on the saving side or the investing side of your journey, because applying investing energy to a saving stage problem wastes years you can never recover. This single diagnostic question should guide every other financial decision. Apply this immediately by calculating your expected annual savings against your expected annual investment growth. Whichever number dominates tells you precisely where your limited time and attention belong right now. And this brings us back to the question we opened with: why the conventional saving advice you've been following may actually be the reason you feel stuck. The answer traces directly to this continuum. Most people apply saving energy to an investing stage problem, or vice versa, and never realize they are pulling the wrong lever entirely. The income flavor lesson. The second lesson, one of the most liberating, is the income flavor lesson. Rather than exhausting willpower fighting small discretionary expenses, redirect that same energy toward growing your income through skill development, scalable teaching, product creation, or career advancement. Income growth carries no mathematical ceiling the way expense cutting eventually does. This single shift transforms wealth building from a restrictive, joyless exercise into an expansive pursuit of opportunity. Most summaries skip this entirely, treating budgeting as the centerpiece, but budgeting protects what you have, while income growth determines how much you ever have to protect in the first place. Both matter, but only one has genuinely unlimited upside waiting for you. The guilt-free spending lesson. The third lesson, perhaps the most emotionally relieving, is the guilt-free spending lesson. Adopt the 2 doubles rule immediately, matching every meaningful splurge with an equivalent investment. This transforms spending from internal conflict into a balanced ritual that honors both present happiness and future security. This is where mainstream advice collapses most dramatically, because gurus often demand either total indulgence or total restriction, when genuine peace lives in the disciplined middle ground. Apply this by identifying one upcoming purchase you've been feeling guilty about and pairing it immediately with an equal investment contribution, proving to yourself that enjoyment and discipline were never actually opposing forces. The Volatility Tolerance Lesson. The fourth lesson, separating disciplined investors from anxious ones, is the Volatility Tolerance Lesson. Internalize completely that market declines are not malfunctions. They are the literal admission price required to access long-term growth. Investors who panic during normal fluctuations consistently sabotage their own outcomes far more than the fluctuations themselves ever could, and this is where the quieter question we planted earlier finally lands. The habit many ambitious people believe is responsible discipline is actually excessive caution disguised as prudence, the instinct to hold cash and wait for safety that never quite arrives. True financial safety comes not from avoiding volatility entirely, but from building the conviction and structure necessary to remain invested through it. The Time Asset Lesson. The fifth and final lesson, closing this masterclass with the most personally resonant insight, is the Time Asset Lesson. The author reflects on setting a personal goal of $500,000 by age 30 and falling short, a vulnerability he later discussed publicly on the Danny Miranda podcast, describing existential uncertainty in his early 20s before finding mentorship through Morgan Housel and recognition after being mentioned on the Tim Ferriss Show. This is where mainstream advice collapses one final time, because money is consistently treated as the ultimate scoreboard, when time itself remains the only truly irreplaceable asset any of us possess. If you leave with nothing else, understand that every framework in this masterclass exists not to help you accumulate numbers in an account, but to help you reclaim the time and freedom those numbers were always meant to purchase in the first place. The Vault Closing. There's something quietly profound about a book that begins with a young man obsessing over the wrong numbers and ends with him understanding that time, not money, is the asset he can never recover. Just Keep Buying succeeds not because it promises a shortcut to riches, but because it dismantles the noise surrounding wealth and replaces it with evidence, patience, and a surprisingly human understanding of why we struggle with money in the first place. This is not a book about getting rich quickly. It is a book about getting free deliberately. Within the next 7 days, choose one specific action. Calculate your own position on the Save Invest Continuum using real numbers from your actual income and spending, not assumptions. That single calculation will tell you immediately whether your energy this year belongs in growing your income, refining your investment approach, or both simultaneously, replacing vague financial anxiety with a concrete, actionable starting point you can begin building on tomorrow morning. And we circle back now to the very first thought this masterclass opened with, the idea that everything you were told about saving money might be the exact reason you are still stuck. The truth this entire masterclass has revealed is that wealth was never about secret information only the rich possess. It was about knowing where you actually stand, matching your effort to that reality, and having the discipline to keep buying, keep growing, and keep showing up long after the excitement fades. If this video gave you even one new, unfair advantage, like this video, subscribe to the Book Vault, and comment below with the single biggest takeaway you are carrying with you tonight, because this private community of ambitious people is just getting started.